U.S. stock markets grapple with economic headwinds and tech sector volatility. Market overview. Thursday's trading session ended on a somber note for Wall Street, as U.S. stocks faced a steep decline influenced by disappointing economic data and unsettling earnings forecasts from pivotal tech companies, notably Meta platforms. The NASDAQ composite fell by 1.4%, while the S&P 500 and the Dow Jones Industrial Average saw declines of 1.3% and 1.6%, respectively. This downturn reflects growing investor concerns about the U.S. economy's capacity to sustain growth amidst the Federal Reserve's ongoing high-interest rate regime. Disappointing GDP growth. A major catalyst for the day's market movements was the newly released GDP data for the first quarter of 2024, which showed that the U.S. economy expanded at a mere 1.6% annual pace, substantially below the expected 2.5%. This figure casts doubt on the strength of the economic recovery, coming at a time when the Federal Reserve has been aggressively raising rates to curb inflation. In response to the GDP report, Treasury yields surged, with the benchmark 10-year yield reaching 4.73%, highlighting the market's recalibration of risk and return expectations in a potentially slowing economy. Tech sector under pressure. The technology sector bore the brunt of the market's pessimism, driven by Meta's startling announcement. The company's stock plummeted by up to 15% following its lower-than-expected revenue forecast and its plan to significantly ramp up spending on AI infrastructure, with a budget of up to $10 billion. This move raised concerns among investors about the duration required for such investments to bear fruit. The ripple effects were felt across the tech sector, with other giants like Microsoft, Alphabet, and Amazon also experiencing notable declines of over 3% each. Industrial and consumer sectors also hit. Further signs of economic softness were evident in the performance of companies like Caterpillar and Whirlpool. Caterpillar's shares dropped more than 7% after the company reported ongoing economic challenges in Europe and Asia-Pacific regions, painting a bleak picture of global industrial demand. Meanwhile, Whirlpool reported a 9% fall in its stock after announcing a drop in sales due to decreased demand for household appliances, a trend exacerbated by a cooling U.S. housing market influenced by high mortgage rates. Investor outlook and macroeconomic indicators. As markets digest these developments, attention is now turning to the Personal Consumption Expenditures Index for March, another crucial indicator of inflationary pressures, set to be released on Friday. This index, closely watched by the Federal Reserve, could provide further clues about the trajectory of interest rate policies. A higher-than-expected inflation reading might confirm the necessity for continued high interest rates, potentially dampening investor hopes for an easing policy environment. Broader economic implications and corporate strategies. The current market dynamics underscore a complex interplay of economic slowdown concerns and strategic shifts in major industries. High interest rates, intended to temper inflation, are simultaneously applying brakes to economic activity. Tech companies, particularly those like Meta investing heavily in next-generation technologies such as AI, face a dual challenge of managing rising costs while proving to investors that their strategies will lead to sustainable growth. Moreover, traditional industries are signaling caution, with companies like Caterpillar and Whirlpool adjusting their strategies in response to weakening global demand. Conclusion. Thursday's market retreat is indicative of broader uncertainties facing the U.S. economy and global markets. Investors are increasingly cautious, weighing the potential impacts of continued high interest rates against corporate earnings reports and economic data releases. As the economic landscape continues to evolve, the coming weeks will be critical for assessing whether these concerns are reflective of a temporary setback or indicative of a more sustained downturn. With more earnings reports on the horizon and key economic indicators forthcoming, the financial markets are poised for further volatility as investors seek clarity on these pressing issues.